I made this for you so you can understand a little bit more about candlesticks and a little bit more about candlestick patterns, head and shoulders. So go and enjoy it. Go and enjoy the show, and hopefully it'll help you some way or another. Make lots of money. Chat later.
Hey everyone, and welcome back to the channel. Today we're diving deep into a topic that's absolutely fundamental for any trader, whether you're just starting out or have been in the game for years. We're talking about price action patterns. Imagine being able to look at a chart and confidently predict where the market is likely to head next, without relying on a dozen confusing indicators. That's the power of understanding price action, and by the end of this video, you'll have the knowledge to start doing just that. So what exactly is price action? In the simplest terms, it's the movement of a security's price over time. It's the story the market is telling us, written in the language of candlesticks. By learning to read this story, we can identify patterns that have historically led to specific outcomes. This isn't about a magic crystal ball. It's about using historical data and market psychology to make informed, high-probability trading decisions. It's pure, it's clean, and it cuts through all the noise. First up, let's talk about the building blocks, Japanese candlesticks. Each candle tells you 4 key pieces of information: the open, high, low, and close price for a specific time period. A green or white candle means the price closed higher than it opened, showing buying pressure. A red or black candle means the price closed lower than it opened, indicating selling pressure. The wicks or shadows show the highest and lowest points the price reached during that period. Understanding this basic anatomy is crucial before we can move on to the patterns themselves. Now for the exciting part, the patterns. Let's start with some of the most powerful single candle patterns. Have you ever seen a candle with a long lower wick and a small body at the top? That's a hammer. It typically appears after a downtrend and signals a potential bullish reversal. It tells us that sellers pushed the price down, but buyers stepped in with force and drove it back up, showing a significant shift in momentum. The opposite of a hammer is a shooting star. It has a long upper wick and a small body at the bottom, usually appearing after an uptrend. This suggests buyers tried to push the price higher, but were overpowered by sellers, hinting at a potential bearish reversal. Another key pattern is the doji. A doji candle looks like a cross because its open and close prices are very close to each other. This signifies indecision in the market. Neither buyers nor sellers are in control. When you see a doji after a strong trend, it can be a warning sign that the trend is losing steam and might be about to reverse. Think of it as the market taking a pause to decide its next direction. Moving on to 2 candle patterns. One of the most famous is the engulfing pattern. A bullish engulfing pattern occurs when a small bearish candle is followed by a larger bullish candle that completely engulfs the previous candle's body. This is a very strong sign that buyers have taken over from sellers and an uptrend may be starting. Conversely, a bearish engulfing pattern, where a large bearish candle engulfs a smaller bullish one, is a powerful signal of a potential move down. Next, we have the piercing line and dark cloud cover. The piercing line is a bullish reversal pattern found at the bottom of a downtrend. It's a 2-candle pattern, where the first candle is bearish and the second candle is bullish. The second candle opens below the low of the first one, but then closes more than halfway up the body of the first bearish candle. This shows a strong rejection of lower prices. The dark cloud cover is its bearish counterpart, appearing at the top of an uptrend and signaling a potential reversal downwards. Now let's look at some larger multi-candle chart patterns. These patterns take longer to form, but can often lead to more significant market moves. A classic one is the head and shoulders. This is a bearish reversal pattern that looks like a baseline with 3 peaks. The middle peak is the highest, called the head, and the 2 smaller peaks on either side are the shoulders. The baseline connecting the lows is called the neckline. When the price breaks below the neckline after forming the right shoulder, it's a strong signal to sell, as it indicates a major trend reversal from bullish to bearish. The opposite of this is the inverse head and shoulders. It's a bullish reversal pattern that looks like an upside-down head and shoulders. It forms after a downtrend and signals that the trend is likely to reverse upwards. A break above the neckline is your confirmation and a potential entry point for a long trade. These patterns are so popular because they represent a clear battle between buyers and sellers, where one side eventually wins out decisively. Another set of common patterns are double tops and double bottoms. A double top is a bearish reversal pattern that looks like the letter M. It forms when the price hits a resistance level twice and is unable to break through. After the second peak, if the price breaks below the support level in between the two peaks, it confirms the pattern and suggests a further decline. A double bottom is the bullish version, looking like the letter W. The price finds support at a certain level twice, signaling that the selling pressure is exhausted. A break above the resistance level between the two bottoms confirms the pattern and signals a potential rally. So how do we put all of this together in a real trading scenario? It's not just about spotting a pattern, it's about context. The most reliable patterns are those that form at key support and resistance levels. A hammer pattern is much more significant if it forms at a major long-term support level than if it appears randomly in the middle of a range. Or, for example, after a bullish engulfing pattern, wait for the next candle to also close higher to confirm that buyers are truly in control before you enter a trade. Combining price action with other tools can also increase your confidence. For instance, you could use volume. A breakout from a pattern accompanied by high volume is much more credible than one with low volume. High volume confirms that there is strong conviction behind the move. You can also use a simple moving average. Don't forget that trading is risky. In fact, 75% of leveraged traders lose money. And if you don't like risk and you don't like losing money, you probably should not be trading. Let's walk through a hypothetical trade. Imagine you're watching a stock that's been in a clear downtrend. You've drawn a major support level on your chart from a previous low. As the price approaches this level, you notice it forms a perfect bullish engulfing pattern right on the support line. This is your first alert. You then look at the volume and see a huge spike on the bullish engulfing candle. This is your second confirmation. You decide to enter a long trade, placing your stop loss just below the low of the engulfing pattern to manage your risk. You set your profit target at the next significant resistance level. This is how you combine pattern recognition, support and resistance, and confirmation to build a high-probability trade setup. It's crucial to remember that no pattern is 100% foolproof. Trading is about probabilities, not certainties. That's why risk management is non-negotiable. Always use a stop loss to protect your capital if the trade goes against you. Don't risk more than a small percentage of your account on any single trade. The goal is not to win every time, but to have your wins be bigger than your losses over the long run. Practice is key. Open a demo account and just spend time watching charts, identifying patterns, and seeing how they play out. Paper trade your setups. This will build your confidence and train your eye to spot these opportunities quickly and accurately. Price action trading empowers you to understand the market's language directly from the source. It simplifies your charts and forces you to focus on what truly matters: price. By mastering these patterns, from simple hammers and dojis to complex head and shoulders, you gain a massive edge. You'll be able to anticipate market moves with greater confidence and develop a trading strategy that is robust and timeless. Thank you so much for watching. I hope this guide to price action patterns has been valuable for you. If you learned something new, please hit that like button and subscribe to the channel for more trading content. Drop a comment below and let me know which price action pattern is your favorite. Until next time, trade safe and see you in the next video.